The stock market is one of the most used areas for wealth creation. Whether you buy individual stocks or ETF through your brokerage account, 401k or IRA, it is a great place to build your nest egg. Within the total return of our investments, a portion of it comes from dividends. Dividend is a portion of the excess cash that a company has and that they don't have a good use of, so they return it to the shareholders. Dividends are not always a fixed value. For example, companies like Coca-Cola have paid an increasing dividend for the last 60 years and continue to do so. But what if I told you that the silent wealth builder I'm going to talk about in this video is not dividends? Can you take a guess? I am talking about stock buyback. A stock buyback is when a company buys its own shares from retail investors that are selling their shares, reducing the amount of the shares outstanding and consequently creating wealth. Share buybacks are usually announced during a company's earnings. The management announces the amount in cash that they are willing to buy. For example, Google announced that they will be buying 70 billion in shares. Keep in mind that the management could change their mind at any time. Also, the company must have excess cash to purchase them. This is how share buybacks looks on the shares outstanding chart. Over time, the share amount goes down. This means more value to the investor holding the stock. Worth mentioning that for REITs, this will be the opposite. Since REITs have to dispose 90% of their income by law, they often increase their share outstanding to raise cash. As mentioned, companies must have an excess of cash in order to buy their own shares. This is when the free cash flow comes in. Free cash flow is the excess amount of cash that the company can use to pay debt, invest to grow the company, pay dividends, or in this case, do share buybacks. In big companies like the ones in the tech sector where they have high paid employees, these type of employees get paid in a combination of cash and shares. This is called stock-based compensation. We want companies to not pay that much of stock-based to their employees because this dilutes the shareholders. The company reduces the shares outstanding while the employee increases for cash. So what are the upsides of a share buyback? Number 1, when the company reduces its shares outstanding, it increases the earnings per share, since there are less shares. Number 2, increases the stock potential upside for the ones who remain holding the company. Because when you split the market cap of the company between the shares investors hold, each one is worth more. Number 3, compared to dividends, it is a tax-efficient way to return earnings to the shareholders. Now, what are the cons? First, buybacks could be used to cover the stock-based compensation of highly compensated employees. This could cause dilution of shares. Number 2, in some rare cases, buyback may allow managers to enrich themselves at the expense of the shareholder. For example, doing buybacks to increase the value of the stocks they hold so they can finally sell at higher profits. And on number 3, buybacks can be poorly done. The management is buying the company's shares at any price instead of the best price, wasting shareholder capital. Overall, share buybacks are the silent wealth builder. Management just tell you once that they are going to repurchase shares, and then you don't know how much they are buying until the next earnings report. Very important that for share buybacks to be effective, the company must not be starving. They must have all their operation expenses covered, money to continue expanding the company, and then an excess amount of cash to buy its own shares. Hope you enjoyed this video. If you learned something new, hit like, subscribe. Thanks for watching, and I'll see you in the next one.